Did we just experience the defining moment within the better for you functional lifestyle products movement? By now, you've undoubtedly seen every CPG pundit with even the smallest soapbox point a smartphone towards their talking head to regurgitate press release details about the Celsius Holdings and Alani Nu M&A news. And that deal news is obviously what my introductory question refers to, but before I give you the legitimate insider deep dive insights I can guarantee won't be found anywhere else on the internet, it would be prudent of me to start by covering the latest Celsius Holdings earnings release information. So I'll use the recently filed fourth quarter and full year 2024 earnings report, notes I took while listening to the earnings conference call, also their recent investor conference as well, and any relevant publicly disclosed news to obviously update you on the recent performance of Celsius energy drinks, but also use it as a contextual backdrop for my expanded strategic commentary around energy drink market dynamics and trends. That being said, let's start with a quick financial update to set the foundation. In the fourth quarter of 2024, Celsius Holdings had revenue of $332.2 million, which was down 4% year over year. And while that now marks the second straight quarter of year-over-year revenue losses, sequential quarter-over-quarter revenue activity increased sharply at 25%. If we break out the quarterly revenue geographically, North America accounted for $311.9 million, which was down 6% year over year. And this negative result was attributed primarily to higher domestic allowances from several programs, including its PepsiCo distributor incentive program. On the international side, Celsius had quarterly revenue of $20.3 million, which was up 39% year over year. And though Celsius is now seeing consistent quarter over quarter and year over year international revenue growth, that wasn't always the case for the energy drink brand. But that relatively weak performance was mostly attributed to internal decision making a handful of years ago, as Celsius leadership smartly focused its attention and resources on fueling the insane growth within the US market. But geographical expansion is now one of the most important strategic pillars inside Celsius, presenting significant opportunity for incremental growth over the next 3 to 5 years. And you can already see some of the early international market development groundwork starting to formalize. In 2024, Celsius began sales activity across the UK and Ireland, France, Australia, and New Zealand. But while international performance continues to exceed initial expectations in those expanded markets, geographical revenue, excluding those expansion markets, increased 8% compared to the prior year period. And while Celsius isn't exclusively utilizing its PepsiCo partnership for global expansion opportunities, it is somewhat attempting to emulate the Monster Energy and Coca-Cola international distribution structures. So using Monster Energy as the opportunity guide for international share of total revenue, Celsius has massive runway left, even if comparing these are apples and oranges for several strategic reasons. But before I transition into sharing a collection of quarterly retail sales and distribution updates that I think are important when trying to understand the Celsius story, I want to quickly mention some full year 2024 financial numbers. During the 12 months ending December 31st, Celsius Holdings had revenue of $1.36 billion, which was an increase of 3% compared to the prior year, with the slight majority of that year-over-year revenue dollar growth coming from international activity. But let's shift into those quarterly retail sales and distribution updates now. And I probably don't need to keep mentioning this, but in the case that someone has been living under a rock for the last several years, things drastically shifted for Celsius because of the August 2022 distribution and investment deal with PepsiCo. Additionally, the entire DSD distributor transition was completed by year-end 2022, and Celsius has now also been fully integrated within PepsiCo's annual planning cycle. In terms of retail dollar sales performance, Celsius increased by 2% year over year, as reported by Circana for the last 13-week period ending December 29th of 2024. Throughout the full year 2024, Celsius reached $2.7 billion in retail sales across tracked channels, growing over 22% year over year and accounting for 30.3% of all category growth. Moreover, Celsius is securely the third largest energy drink brand in the category and ninth largest liquid refreshment beverage overall, with its full year 2024 market share within the US energy drinks market currently at 11.8%. And I understand that I'm a broken record by this point, stating this again, but I'd hate to gloss over that accomplishment, as Celsius became the first brand in over a decade not named Red Bull or Monster Energy that was able to capture more than a 10% share in the US energy drinks market. But that being said, how can Celsius possibly push even further, maybe towards a 15% share? And I know that probably sounds a bit crazy, but it's important to realize that there are more than a dozen large US metro areas where Celsius is plus or minus 2 points of a 15-point share. So it really comes down to a strategic growth framework that Celsius recently branded as more people, more places, and more often. But in terms of beverage blocking and tackling strategy, that primarily is achieved by one, increasing sales velocity and buy rate, but also two, increasing total distribution points, which is comprised of ACV and items per store. PepsiCo continues to facilitate ACV expansion for Celsius, supporting new customer acquisitions across broad demographics and new usage occasions. But honestly, the energy drink brand is basically at full distribution now, with products sold at over 241,000 locations. So beyond the velocity and buy rate elements, TDP growth will have to come from increased items carried per store. And going forward, Celsius will increase items per store through a combination of product strategies like flavor, format, pack size, and variant expansion. Finally, the company will seek more store placements, like leveraging cold display activity in Celsius branded coolers, as this strategy, especially locating them near checkouts, has proven to be highly effective with increasing impulse purchases. Next, I want to highlight a non-tracked sales channel that sits perfectly within the intersection of that Celsius strategic growth framework. Since the PepsiCo deal, Celsius has been able to expand rapidly into thousands of non-traditional outlets like colleges, hospitals, at-work micro markets, and restaurant locations across the United States. And Celsius leadership specifically called out its recent partnership announcement with Subway that now represents a total opportunity of 18,000 locations and landing placements in hundreds of Home Depot locations nationwide. But over the last few years, I've shared the performance of various non-tracked channels from Amazon to food service and wholesale clubs, partly because they've played an outsized role in the Celsius brand journey, but also because I was trying to highlight the evolving shopping patterns of energy drink consumers. Yes, convenience still has the largest channel share of US energy drink sales, but brands must begin adjusting to a new marketplace reality, as the Great Shutdown period changed categorical shopping patterns likely forever. But for this final portion of the content, let's shift into everything you need to know about the M&A news that accompanied this earnings release, along with a ton of extra insider deep dive insights I can guarantee won't be found anywhere else on the internet. Celsius has entered into a definitive agreement to acquire Alani Nu for a net purchase price of $1.65 billion, comprising of a mix of cash and stock. Moreover, the approximately 22.5 million shares of newly issued restricted Celsius Holdings common stock will represent about 8.7% ownership. The stock consideration will be subject to a lockup period, which will be released over a 2-year period, aligning long-term interests to drive future growth and value creation. And in terms of valuation details, because I know other founders get off on this kind of information, Alani Nu had revenue of $595 million and adjusted EBITDA of $87 million, representing an attractive 2.8x revenue multiple and 19x EBITDA multiple before you take into consideration the $50 million of run rate cost synergies that are expected to be achieved over the next 2 years after the deal closes in the second quarter of 2025. But before we dive into business combination considerations, I wanted to show some love to the absolute rocket ship recent performance of Alani Nu energy drinks, especially since my boy and brand co-founder Hayden Schneider hates that everyone overlooks the brand. In 2024, Alani Nu became the 4th largest US energy drink brand, reaching more than $800 million in retail sales across tracked channels, growing at an astonishingly high rate of 63% year over year. And even more insane, those year-over-year growth rates have even increased to 78% when looking at the last 4-week period ending January 26 of 2025. Moreover, Alani Nu dollar share of the energy drinks category is just shy of 5%. But then knowing those Alani Nu commercial metrics, the combined brand platform would have generated slightly below $2 billion in revenue and more than $3.5 billion in tracked channel retail sales over the full year 2024 period. Moreover, the combined brand platform would have 16% category share, trailing only the Monster Energy combined brand platform and Red Bull. Also, it would be considered the fastest growing energy drink brand portfolio of the top 10 categorical competitors. But beyond the obvious top line growth stuff, why did Celsius acquire Alani Nu? I believe the acquisition uniquely represented a dream business opportunity where Celsius could have its cake and eat it too. Or I guess a better analogy would be have its energy drink and chug it too. By acquiring Alani Nu, Celsius further strengthens its ability to benefit from expected long-term categorical tailwinds, but equally diversify itself from potential short-term headwinds. Over the last 2 decades, Celsius has been on the right side, albeit arguably too early, of this massive evolution within the energy drinks market as consumers continue to move closer towards this four-way intersection of taste, convenience, nutrition, and functionality. And since energy drinks have been marketed as lifestyle brands that offer beverages with a functional benefit of energy, brand authenticity matters a lot. To go one step further, energy drinks have become status symbols or basically aspirational mixtures representing flavor taste, lifestyle taste, and identity by association. So while the Alani Nu energy drinks launched something like 14 years later, it's equally well positioned to benefit from expected long-term categorical tailwinds, but also complementary and incremental to Celsius in target audience, product innovation approach, and brand strategy. Now, does that mean Celsius will avoid cannibalization risk? No, but it's much less concerning compared to what I mentioned previously in content around KDP acquiring Ghost. You might be thinking, aren't these two brands competitive and thus would cannibalize each other? Well, KDP's chief strategist, Justin Whitmore, seems to rightfully understand the high-level brand distinction, which is that consumers have bucketed C4 Energy into performance and Ghost into cool lifestyle. And that's great, but when we're talking about beverages, not supplements, this is a war still fought on the ground. And what I mean by that is that it revolves around actions like field sales and marketing, distribution, and customer and channel management. This is where dreams become reality and nightmares are hiding around every corner. It will come down to effective and clear communication from KDP Corporate and its field teams and effective and clear communication from these brands, so C4 and Ghost, to not only KDP Corporate, but KDP Field and their own field teams. Honestly, this is what would keep me up at night if I were either Doss Cunningham or Dan Lorenzo. Beyond that, having the right incentive structure with KDP will be key, and Ghost should have the upper hand here. This is because while C4 Energy is currently a tad larger in terms of retail sales, and KDP is more familiar with that company, KDP has more ownership in Ghost, and honestly, negotiating after C4 Energy has its own game theory advantages. Regardless, this is where I'd be super concerned long term about KDP portfolio architecture, them retaining brand distinctiveness, and ultimately the Ghost brand authenticity. And maybe since I'm sharing old clips, I should probably clear up why I've generally been positive in this content about Celsius acquiring Alani Nu, but said this about PepsiCo acquiring Alani Nu last November. In this kind of PepsiCo if-then hypothetical situation, the only important categorical name that makes sense is Alani Nu, even though I'd argue that would be a huge negative for Celsius Holdings if it happened. And it very much relates to the other clip I just shared about being super concerned long-term that a very large, multi-layered, bureaucratic beverage organization could retain brand distinctiveness and authenticity. So I believe the long-term brand amalgamation risk is much lower when Celsius owns Alani Nu compared to PepsiCo owning both brands. But then that presents another question, right? And that's because wouldn't these risks be largely unavoidable anyways, with PepsiCo having the first right of refusal to distribute Alani Nu energy drinks under the Celsius deal from a few years ago? Currently, Celsius leadership has been avoiding the Alani Nu distribution plans, which makes me think they might want to keep them separated to minimize the brand platform's key customer risk with PepsiCo. Additionally, keeping distribution network continuity, especially in the near term, would help Celsius stay focused on other business integration elements, driving synergies, and staying disciplined on driving the next phase of brand growth. But while distribution gains and channel expansion will be included within the next phase of Alani Nu growth, arguably the most exciting for Celsius will be in its ability to leverage the brand's additional product formats to access customers in growing wellness lifestyle adjacencies. This desire for Celsius format and category expansion is something I've predicted in content the last several years. John Feldley said that they are always looking at adjacent categories such as functional water, hydration, and protein. And this lines up perfectly with something I predicted in November of 2023, which doesn't surprise me because I know the Celsius leadership team and board members are avid followers of my content. I think when the investment came from PepsiCo last year, everybody assumed it would just be a matter of time before Celsius Holdings was wholly owned by Big Blue. But what I'm proposing is that Celsius won't be eaten, at least entirely, by PepsiCo, and will instead be the one eating. And this transitions into my last point or advice for Celsius around brand architecture. With that same recent interview, John Feldley pondered how far the Celsius brand could stretch. And I'd caution utilizing a branded house or other more singular brand architecture. Instead, I'd rather have Celsius Holdings be a house of brands that separates the consumer benefit platforms. And while company leadership ultimately didn't take my unprompted strategic advisory when it recently launched Celsius hydration stick packs, I technically did still get my desired outcome with the Alani Nu acquisition, creating a house of brands. But though I could pontificate forever on highly probable future product extensions involving one or both platform brands, which unfortunately I believe will eventually expose a strategic weakness inside the Celsius organization, I'm going to save that in-depth subject matter exploration for later content pieces. Instead, I want to shift this final part of the content into quickly mentioning 3 different external triggers caused by this M&A activity. Firstly, does this mean more large-scale energy drinks market consolidation will happen soon? While I'd prefer to see Nutrabolt IPO, I think that KDP will attempt a larger buyout to fix the misalignments that were caused by their Ghost acquisition. And I'm sure the middle market could see some deals, but it's slim pickings right now for a target that would create material impact for large beverage portfolios. Secondly, will this create another round of the independent DSD musical chairs game? And that will largely depend on how Celsius handles the Alani Nu distribution strategy. Finally, what's next for the previous owners or founders of Alani Nu? I'd guess that Katie and Hayden focus on family, personal interests, and other entrepreneurial efforts. But the more intriguing exploration, at least for my audience, would be around Max and Trey. These are still 2 young, aggressive entrepreneurs that co-founded Prime with Logan Paul and KSI, a beverage brand that still generates over $500 million in US tracked channel retail sales, ownership involvement in Lunchly that includes Mr. Beast, and own the infrastructure that runs everything called Congo Brands. So with excess capital from the deal, how soon will we see some of it deployed towards finding and scaling a new talent-led brand creation? These guys are talent whale hunting with previous rumored beverage projects with Morgan Wallen before working with Real Tea and Mr. Beast, which means whatever comes next will certainly be impactful to the CPG space. But I hope you enjoyed the first principles thinking that went into my latest YouTube video. If you did, can you do me a favor by hitting that like button? That quick and free action helps YouTube know my content is worth spreading to more people. Also, we're getting really close to reaching my next subscriber goal, and it would be great if you join me on this journey. But to do that, we need to fix the fact that slightly more than 3/4 of you that are watching this video right now are not subscribed to my YouTube channel, and that hurts my feelings. Regardless, I want to thank you for giving me some of your attention and time, and I'll see you on the next one.